3 days ago on Friday, the January 30th, something happened that could change how much interest you earn on your savings account, what rate you pay on your mortgage, and how your 401k performs over the next 4 years. Donald Trump nominated Kevin Warsh to be the next Federal Reserve Chairman. And within hours, gold had its biggest one-day crash since the early 1980s. The dollar had its best day since July, and $6.6 trillion in Federal Reserve assets suddenly had a new boss coming. Whether you voted red or blue, whether you follow markets or not, this decision affects your money. Let me show you how. Look, this isn't about politics. This is about the guy who controls interest rates. The person who decides whether your savings are in 4% or 2%, whether mortgages stay at 7% or drop to 5%, whether your retirement account grows or stagnates. Kevin Warsh is 55 years old. He served on the Federal Reserve Board before, from 2006 to 2011. He knows the job. But here's what you need to understand. The decisions he makes over the next 4 years will directly impact $4.5 trillion in markets. And that includes your money, your savings, your mortgage, your retirement. So let me break down exactly who this guy is, what he plans to do, and what it means for your wallet. Let me start with the basics. Who is Kevin Warsh? 55 years old, Stanford University graduate, Harvard Law School, started his career at Morgan Stanley as an investment banker. Smart guy, connected guy. 26, President George W. Bush appoints him to the Federal Reserve Board of Governors. Warsh is 35 years old. The youngest Fed governor in history, think about that. 35, running monetary policy for the entire United States. He serves for 5 Discover More. Phone digital marketing tools, video editing, software years 2006 to 2011. This period includes the 2008 financial crisis, the worst economic disaster since the Great Depression. Warsh is there working alongside Fed Chairman Ben Bernanke, helping navigate the crisis. During this time, Warsh earns a reputation. He's considered an inflation hawk. What does that mean? It means he's more worried about inflation than unemployment. He wants higher interest rates, tighter money supply. He criticizes the Fed's massive bond buying programs, says they'll cause inflation, says they're enabling government overspending. 2011. Warsh resigns from the Fed, goes to Stanford, becomes a fellow at the Hoover Institution, a conservative think tank. Lectures at Stanford Graduate School of Business. And here's an interesting detail. His father-in-law is Ronald Lauder, the Estee Lauder cosmetics heir, billionaire, major Trump donor, Trump's friend for years. So Warsh has connections to Trump through family, through business circles. They've known each other a long time, 2017. When Trump is looking for a new Fed chair, Warsh is on the short list. Trump interviews him, considers him seriously, but ultimately picks Jerome Powell instead. Now, 7 years later, Trump is picking Warsh. Powell's term as chairman expires May 15th, 2026, and Trump wants Warsh to replace him. On Friday, January 30th, Trump posts on Truth Social, quote, "I have known Kevin for a long period of time and have no doubt that he will go down as one of the great Fed chairmen, maybe the best. On top of everything else, he is central casting, and he will never let you down." End quote. Central casting. That's Trump's way of saying Warsh looks the part, sounds the part, projects authority. But here's what matters more than his resume or his connections. What does Warsh actually believe about monetary policy? What will he do as Fed chairman? And how does that affect you? And here's what caught everyone's attention on Friday. Within hours of the announcement, gold crashed down 5% in one day. That's the biggest one-day drop since the early 1980s. Why? Because markets think wars will be tougher on inflation than people expected. And when inflation fears drop, people sell gold. But here's the complication. Warsh's views seem to have changed. Let me show you the contradiction that has some people worried and others relieved. 2008 to 2011, Warsh is at the Fed. The economy is in crisis. Unemployment hits 10%. The Fed, under Chairman Bernanke, launches quantitative easing, QE buying massive amounts of treasury bonds and mortgage-backed securities. The goal is to push down long-term interest rates, make borrowing cheaper, stimulate the economy. Warsh opposes this. He votes against it multiple times. He says buying all these bonds will cause inflation. He says it's enabling the government to spend recklessly. He wants the Fed to focus only on its core mandate, price stability, and maximum employment, nothing else. He's a hawk. He wants tighter money, higher rates, smaller Fed balance sheet. Now, fast forward to 2025. Warsh interviewed on CNBC in July. He says the Fed has a, quote, credibility deficit. He calls for, quote, regime change at the Fed. He says the current leadership has failed. And here's where it gets interesting. Warsh now aligned with Trump. Trump has been calling for much lower interest rates, saying Powell was, quote, too late cutting rates, calling Powell a, quote, fool. Warsh, the former hawk who opposed easy money, is now supporting Trump's calls for lower rates. Senator Elizabeth Warren noticed this on January 30th, the day of the nomination. She said, quote, That's exactly what a sock puppet does. If Donald Trump says it, then Kevin Warsh echoes it, even though it contradicts everything he had done for years. End quote. Sock puppet. That's harsh. But it points to the key question. Has Warsh genuinely changed his views? Or is he telling Trump what Trump wants to hear to get the job? Market analysts are split. Some say Warsh's hawkish instincts will reassert themselves once he's chairman, that he'll resist Trump's pressure for low rates if inflation is still a problem, that his independence will show through. Others worry he's already proven he'll bend to political pressure, that Trump wouldn't nominate him unless Warsh promised to cut rates aggressively. Here's what we know for sure. Warsh has two competing impulses. One, his traditional hawkish views: control inflation, shrink the Fed balance sheet, don't let politicians dictate monetary policy. Two, his alignment with Trump, his family connections, his desire for the job he's wanted since 2017. Which impulse wins? That determines what happens to your money. Let me explain the single biggest decision Warsh will make and why it affects $4.5 trillion in markets. The Federal Reserve currently owns $6.6 trillion in assets. Let me say that again, $6.6 trillion. That's bonds, treasury securities, mortgage-backed securities. How did the Fed accumulate all this? Two reasons. 2008 financial crisis. The Fed started buying bonds to push down long-term interest rates. This is quantitative easing. QE. The balance sheet goes from under $1 trillion to over $4 trillion. COVID pandemic 2020. The economy shuts down. The Fed buys even more bonds. The balance sheet peaks at nearly $9 trillion in 2022. Since then, Powell has been slowly reducing it, letting bonds mature without replacing them. The balance sheet is now down to $6.6 trillion, but it's still massive. Historically massive. Before 2008, the Fed's balance sheet was under $1 trillion. Now it's $6.6 trillion. Warsh thinks this is a problem. He said the Fed's balance sheet is, quote, bloated, that it's enabling government deficit spending, that it needs to shrink dramatically. So here's the question. How fast does Warsh shrink it? And what does that mean for markets? If Warsh sells bonds aggressively or lets them mature quickly, that's a lot of supply hitting the market. Bond prices fall, yields rise, interest rates across the economy go up, mortgages get more expensive, car loans cost more, corporate borrowing becomes harder. The stock market faces pressure because higher rates mean lower company valuations. This happened before 2013. The Fed just hinted that it might start reducing bond purchases. Markets panicked. This was called the taper tantrum. Bond yields spiked, stocks crashed temporarily. The Fed had to slow down its plans. If Warsh tries to shrink the balance sheet too fast, we could see taper tantrum 2.0 except bigger because the balance sheet is bigger. Estimates suggest if Warsh successfully reduces the balance sheet by 2 to 3 trillion over his term and markets react to that process, the total impact could affect 4 to 5 trillion in asset values across bond stocks and real estate. That's where the 4.5 trillion number comes from. It's not one specific pool of money. It's the cumulative market impact of Fed balance sheet decisions, interest rate changes, and the ripple effects through the economy. And you're exposed to this. If you own bonds, either directly or through bond funds in your 401k, you're affected. If you own stocks, you're affected. If you have a mortgage or want to buy a house, you're affected. If you have money in a savings account, you're affected. 4.5 trillion sounds abstract, but it's not. It's your retirement account, your home equity, your savings, your borrowing costs. I'm posting updates on Warsh's Senate confirmation and what it means for interest rates to our WhatsApp channel, Economy Meet History. The confirmation hearings are coming in February or March. Senators will grill him on Fed independence and Trump pressure. When key developments happen, you'll know immediately what it means for your money. Link in description. Let me get specific. How does the Warsh nomination affect your actual money? Let's go through each category. Your savings account. Right now, if you have a high-yield savings account, you're probably earning somewhere between 4 and 5% annual percentage yield. That's pretty good, historically good. Why are rates that high? Because the Federal Reserve's benchmark rate is currently 3.5 to 3.75%. Banks base their savings rates on the Fed rate. If Warsh cuts the Fed rate, your savings rate drops. Simple as that. If the Fed rate goes down to 2%, your savings account might earn 2.5 or 3%. You earn less on your cash. Now, Warsh's complication is this. Trump wants lower rates. Warsh traditionally opposed lower rates. So, which way does he go? Short term, he'll probably cut rates somewhat to appease Trump to stimulate the economy. Markets are currently expecting 2 to 3 rate cuts in 2026. But if inflation stays elevated, if it ticks back up above 3%, Warsh might pause or reverse course because his hawkish instincts kick in. Bottom line for savers, expect rates to come down somewhat. Maybe not as much as Trump wants, but down from current levels. Your savings will earn less. Your mortgage, this is more complicated. Right now, 30-year fixed mortgage rates are around 6.5% to 7%. That's high. Historical average is closer to 5%. You'd think if Warsh cuts the Fed rate, mortgage rates would drop too. But it's not that simple. The Fed rate affects short-term borrowing costs. Mortgages are long-term, 30 years. Mortgage rates are based more on long-term Treasury yields and mortgage-backed securities prices. And here's the problem. If war shrinks the Fed balance sheet, the Fed is selling mortgage-backed securities. That pushes mortgage rates up, not down. So you could have this scenario. The Fed cuts its benchmark rate. That helps short-term borrowing like credit cards and car loans. But mortgage rates stay high or even go up because the Fed is selling MBS. This would be frustrating for potential home buyers. You're waiting for rates to drop so you can afford a house, but they don't drop because of the balance sheet issue. Bottom line for homeowners and buyers, don't expect dramatic mortgage rate relief in 2026. Maybe some improvement, but the housing market will likely stay challenging. Your 401k, stock market exposure. This depends on two competing forces. Lower interest rates generally help stocks. Companies can borrow cheaper, invest more, grow faster. Stock valuations go up because future earnings are discounted at lower rates. But higher inflation hurts stocks. It squeezes profit margins, makes everything more expensive. And if the Fed has to raise rates later to fight inflation, that's bad for stocks too. So war's challenge is cutting rates enough to help the economy, but not so much that inflation comes back. If he threads that needle, stocks do okay, maybe even rally. If he cuts too much and inflation surges, stocks suffer. If he doesn't cut enough and the economy slows, stocks also suffer. Bottom line for retirement accounts, expect volatility. The next 12 months will be bumpy as markets figure out what kind of Fed chairman wars will be. Long term, it depends on whether he can maintain low inflation while supporting growth. Your job. This is the real world impact people forget. Interest rates affect hiring. If rates stay high, businesses find it expensive to borrow for expansion. They delay projects, freeze hiring, sometimes lay people off. If rates come down, borrowing gets cheaper. Companies expand, hire more. The job market improves. But if rates come down too much and inflation returns, then companies face higher costs for labor and materials, profit margins shrink. They cut costs, including jobs. So again, balance matters. Warsh needs to find the sweet spot. Low enough rates to keep the economy growing, high enough to keep inflation under control. Bottom line for workers, your job security over the next few years will partly depend on whether the Fed gets this right. Rate decisions aren't just abstract finance stuff. They affect whether your company is hiring or laying off. Now, let me tell you about the political fight that could derail this whole thing. Warsh can't become Fed chairman automatically. The Senate has to confirm him. That means hearings before the Senate Banking Committee, then a vote by the full Senate. Republicans control the Senate, 53 seats to 47. So you'd think Warsh is a lock, but it's not that simple. Senator Tom Tillis, Republican from North Carolina, he's on the Banking Committee. And on January 30th, he announced he will oppose War's confirmation, at least for now. Why? Because of the DOJ investigation into Jerome Powell. Remember, the Department of Justice is investigating Powell over his congressional testimony about the Fed headquarters renovation. Tillis says this investigation is inappropriate, political intimidation. Tillis's position is simple. Quote, protecting the independence of the Federal Reserve from political interference or legal intimidation is non-negotiable. End quote. He won't vote to confirm Warsh until the DOJ investigation of Powell is resolved. And Senate Majority Leader John Thune, when asked if Warsh can be confirmed without Tillis, said, quote, probably not, end quote. So Republicans might not have the votes if Tillis holds firm. If other Republicans join him, the confirmation could fail. Democrats are also skeptical. Senator Elizabeth Warren calls Warsh a sock puppet. Senator Mark Warner says it is, quote, difficult to trust that any chair of the Federal Reserve selected by this president will be able to act with the independence required of the position, end quote. But here's the thing. Some Democrats might actually prefer Warsh over the alternatives. The other candidates Trump was considering included Kevin Hassett, who's seen as even more willing to cut rates recklessly. Warsh at least has traditional Fed experience and credibility, so the Senate math is uncertain. Hearings will happen in February or March. Warsh will be grilled on Fed independence, on Trump pressure, on his flip from hawk to dove. If he convinces enough senators that he'll maintain independence, he gets confirmed. If he seems too willing to do Trump's bidding, he might not. And if Warsh doesn't get confirmed, Trump would have to nominate someone else. Powell's term expires May 15th. The clock is ticking. And here's what makes this so important for you. If Warsh gets confirmed and proves to be independent, markets will stabilize. If he gets confirmed and just does whatever Trump wants, inflation could return. If he doesn't get confirmed at all, months of uncertainty follow. Your retirement account, your savings, your mortgage plans, all in limbo while Washington fights. That's why you need to watch this closely. Let me show you what markets did within hours of the Warsh nomination because it tells you what smart money thinks. The dollar. Bloomberg Dollar Spot Index had its best one-day gain since July, up 0.8%. That's a big move for currencies. Why did the dollar rally? Because markets think Warsh will be tougher on inflation than expected. Tougher on inflation means higher rates for longer. Higher rates make the dollar more attractive to foreign investors. They buy dollars to get the higher returns. The dollar had been sliding for a month. Hit lows not seen since 2022. Warsh's nomination reversed that instantly. Gold massive crash down 5% in one day. Some reports say it was the biggest one-day drop since the early 1980s. Why? Gold is an inflation hedge. If you think inflation is coming, you buy gold. If you think inflation is under control, you sell gold. Markets interpreted the Warsh nomination as bearish for inflation. He'll keep it under control, so they dumped gold. Silver crashed even harder, down 13%. Some reports said 30% in certain markets. Absolutely crushed. Treasury bonds. The 10-year Treasury yield hit 4.24%. That's a key psychological level. 2-year yields dipped slightly. 30-year yields rose a bit to 4.87%. What this tells you is markets expect wars to keep rates relatively high for a while. Not the aggressive cuts Trump might want, but a more measured approach. Stock market initially down 0.5%, but recovered some losses as the details clarified. Stocks don't love high rates, but they don't love uncertainty either. Warsh at least provides some clarity. He's experienced, credible. Markets know what they're getting better than some alternatives. So the Friday market reaction was basically relief. Not enthusiasm, but relief. Could have been worse. Could have been Kevin Hassett or someone with zero Fed experience. Warsh is known. His track record exists. Markets can model what he might do. But here's the key. Friday was just the initial reaction. The real moves happen over the next 4 years as Warsh actually makes decisions, cuts rates or doesn't, shrinks the balance sheet or doesn't, stands up to Trump or doesn't. Those decisions will create the real market impacts, the $4.5 trillion in affected assets, the changes to your savings, your mortgage, your 401k. Let me give you practical steps. What should you actually do with this information? First, don't panic. Warsh isn't even confirmed yet. Powell is still chairman. Nothing changes before May 15th at the earliest. You have time. Second, understand your exposure. Look at your retirement accounts. How much is in stocks versus bonds versus cash? If you're heavily in bonds and wars shrinks the balance sheet aggressively, bond prices could fall. You might want to rebalance towards shorter-term bonds that are less sensitive to rate changes. If you're heavily in stocks, expect volatility. But if you're investing for the long term, 10, 20, 30 years, short-term Fed decisions matter less. Don't make drastic changes based on who's Fed chairman. Third, consider your saving strategy. If rates are likely coming down over the next year or two, lock in current high rates where you can. Certificates of deposit, Treasury I-bonds if inflation stays elevated. Don't keep everything in savings accounts that will drop when the Fed cuts. Fourth, if you're planning to buy a house, manage your expectations. Mortgage rates probably won't drop dramatically in 2026. Maybe some improvement, but don't count on 6% mortgages becoming 4%. It's not happening soon. If you already have a mortgage, consider whether to refinance if rates do drop a bit. Run the numbers, but don't rush. Make sure the math actually works. Fifth, watch the confirmation hearings. Listen to what Warsh says about independence, about Trump pressure, about his plans for the balance sheet. His answers will tell you a lot about what's coming. Sixth, diversify. This is always true, but especially now. Don't have all your money in one type of asset. Stocks, bonds, real estate, cash, maybe some commodities. Spread the risk. No matter what Warsh does, some of your assets will do okay. Seventh, stay informed. Fed decisions happen at scheduled meetings 8 times per year. After each meeting, the Fed releases a statement. The chairman holds a press conference. Pay attention. The language they use gives clues about future moves. And finally, talk to a financial advisor if you have one or consider getting one. Someone who can look at your specific situation, your age, your goals, your risk tolerance, and help you navigate whatever war does. This isn't about timing the market. It's about understanding the landscape and positioning yourself wisely. Let me bring this all together. On Friday, January 30th, 3 days ago, Donald Trump nominated Kevin Warsh to be the next Federal Reserve Chairman. Warsh is 55, former Fed governor. Experienced, connected to Trump through family and business, he faces a potentially tough confirmation battle. Senator Tillis already opposing, Democrats skeptical. Hearings in February or March. If confirmed, he takes over May 15th when Jerome Powell's term expires. and the decisions he makes will affect $6.6 trillion in Federal Reserve assets, $4.5 trillion in related market impacts, and most importantly, your money, your savings account interest, your mortgage rate, your 401k balance, your job security. The big questions: will maintain Fed independence or bend to Trump pressure? Will he cut rates aggressively or cautiously? Will he shrink the balance sheet fast or slow? Markets reacted. Friday, dollar up, gold and silver crashed, bonds mixed, stocks initially down, then recovered. But those were just initial reactions. The real story unfolds over the next 4 years. Here's what you need to know. Warsh is more credible than some alternatives. He has experience. He's not likely to do anything reckless. But he also seems aligned with Trump's desire for lower rates, and that creates tension. Lower rates help borrowers, hurt savers, stimulate the economy, risk inflation. Your job is to watch how this plays out. Adjust your financial plans accordingly. Don't panic, but don't ignore it either. Subscribe to this channel, hit notifications, because over the next 4 years, Fed decisions will move markets, change rates, and impact your wealth. Understanding what's happening and why puts you ahead of 99% of Americans who do not pay attention until it is too late. Kevin Warsh might be the next Fed chairman, might not be. But either way, someone will be making these decisions. And those decisions affect you whether you follow them or not. Better to know what's coming, better to be prepared, better to protect your family's financial future. This is Economy Meet History. And the history of Fed chairmen teaches us one thing. Their decisions have consequences for markets, for the economy, for your money.